For the longest time, U.S. Treasuries were the financial equivalent of a weighted blanket of gold. U.S. bonds derived from bondage, and slaves were once the collateral for mortgages. However, gold and Bitcoin created a store of value removed from chains in an open-source protocol. U.S. Treasury bonds were seen as the safest place on earth to park your money. Think of them as a super secure IOU from the U.S. government. You lend Uncle Sam some cash, and he promises to pay you back with a little extra on top, a concept known as interest. For decades, this was the bedrock of the global financial system. Countries, companies, and your grandma's retirement fund all bought these bonds because the U.S. always pays its bills. It was the one thing you could count on in a world full of financial chaos, like a golden retriever in a room full of angry chihuahuas. It was stable, predictable, and frankly, a bit boring, which is exactly what you want from a safe investment. Now let's talk about a word that sounds like it belongs in a medieval morality play, usury. At its core, usury is the practice of lending money at unreasonably high rates of interest, essentially profiting from someone else's need. While the U.S. government's interest rates weren't exactly loan shark levels, the entire system is built on an ever-expanding mountain of debt. The government spends more than it takes in, so it issues more and more treasuries to cover the difference. The U.S. government is now paying over $1 trillion on interest per year. As of early 2025, that debt has ballooned to over $36 trillion. That's a number so large it looks like a typo. To keep this massive machine running, the U.S. needs a constant stream of lenders, both at home and abroad, to keep buying its IOUs, creating a perpetual cycle of borrowing to pay off old borrowing. This system worked brilliantly as long as everyone believed in the promise. Countries like China and Japan bought trillions of dollars worth of these bonds. For China, it was a smart move. They sold us tons of stuff, got a lot of US dollars, and then used those dollars to buy US debt and inflation. This helped keep their own currency's value down, making their exports cheaper and fueling their economic miracle. It was a cozy, if slightly weird relationship. We got cheap TVs, and they got a safe place to store their massive pile of cash. The US got to fund its lifestyle on credit, and the world got a stable financial anchor. Everyone seemed to win, as long as no one looked too closely at the foundations. But here's the thing about promises built on ever-increasing debt: they are incredibly fragile. The whole arrangement depends on unwavering trust in the US government's ability and willingness to manage its finances responsibly. For years, that trust was a given. The US dollar was king and US treasuries were its throne. But what happens when the king starts acting erratically? What happens when the world's biggest borrower looks less like a stable superpower and more like a college student with a new credit card? The lenders, the very people propping up the system, start to get nervous. And that's when the weighted blanket starts to feel less like a comfort and more like a trap. So that cozy relationship I mentioned, it's currently in a very messy, very public breakup. Foreign countries, and especially China, are slowly but surely backing away from US treasuries. It's like they've finally read our texts and realized we're not the reliable partner we claim to be. China's holdings of US debt have plummeted to levels not seen in over a decade, dropping below $800 billion by the end of 2024. This isn't just a minor adjustment, it's a deliberate strategy. They are actively de-dollarizing, which is a fancy way of saying they are trying to break up with the US dollar and, by extension, our debt. It's the global equivalent of someone quietly unfriending you on all social media platforms. Why the sudden cold shoulder? Well, for one, geopolitical tensions have made the idea of holding your rival's debt seem a bit awkward. When you're in a trade war, as the US was in 2025, handing your adversary cash to fund their government feels counterproductive. Furthermore, the US has shown a willingness to use its financial power as a weapon, freezing the assets of 30 countries it doesn't like. For a nation like China, the risk that their massive treasury holdings could one day be used as leverage against them is very real. They've realized that parking all their savings in their competitor's bank account might not be the smartest long-term plan. It's not just about politics, it's also about basic financial sense. The US has a nasty habit of solving its economic problems by simply printing more money, a process politely called quantitative easing. While this helps the US government pay its bills, it devalues the dollar and erodes the real value of the debt held by foreign countries. Imagine lending someone $100, and they pay you back with $100 that can only buy what $80 could before. You'd be furious. That's essentially what the US has been doing to its creditors for years. China and BRICS nations are tired of watching their massive savings shrink thanks to American inflation. So, they are diversifying and hedging. They are investing in other assets, like gold, and trying to build alternative financial systems that don't rely on the dollar. This is a huge deal. For decades, the world had no real alternative to US Treasuries. Now countries are actively seeking an exit. This decline in foreign demand means the US has to find new buyers for its ever-growing pile of debt. This puts more pressure on domestic investors and the Federal Reserve itself to soak up the difference, which is like having to ask your mom for a loan because all your friends have cut you off. It's not a good look, and it signals a monumental shift in global power. Let's talk about the cruel, inverse logic of the bond market. It's simple, but it's the reason your safe investments can suddenly give you a heart attack. When interest rates go up, the value of existing bonds goes down. Think about it. If you bought a bond last year that pays 3% interest, and today the government is selling new bonds that pay 5%, your old bond looks about as appealing as a dial-up modem. No one wants to buy your low-yield bond for its original price when they can get a much better deal on a new one. So the market price of your safe bond plummets. This is called interest rate risk, and it's the monster under the bed for every bond investor. And lately that monster has been having a party. Between 2022 and 2025, the bond market has experienced a series of brutal crashes. To fight raging inflation, the Federal Reserve hiked interest rates at a dizzying pace. This move was a wrecking ball for the bond market. The value of all those low-interest treasuries issued over the last decade collapsed. This wasn't just some abstract number on a screen, it had devastating real-world consequences. It's what blew a hole in the balance sheet of banks like Silicon Valley Bank in 2023, causing their spectacular failure. They were sitting on a mountain of safe government bonds that had suddenly become toxic losses. The situation got even weirder. During the market turmoil of April 2025, driven by fears of a global trade war, something deeply unsettling happened. Normally, when investors get scared, they rush to the safety of US Treasuries, causing their prices to rise. But this time, they fell. Both stocks and bonds were tanking together. This shattered one of the core principles of modern investing, that bonds are your safe harbor in a storm. It was like finding out that your lifeboat also has a leak. The very asset that was supposed to protect you was now sinking right alongside everything else, leaving investors with nowhere to hide. The Trump administration has announced the Big Beautiful Bill, a $1.5 trillion deficit exchange that includes AI Stargate and Doge, interlinking digital ID control system. This instability spending completely changes the US credit rating game and places US debt ratio near Greece before it defaults. If US Treasuries and banks are no longer a reliable safe haven, then the entire foundation of the global financial system becomes shaky. For decades, the promise was simple: in times of crisis, buy bonds. But if that promise is broken, what comes next? The rising interest rates needed to attract buyers for new debt make old debt worthless, creating financial crises. This forces the government into a terrible corner: either let interest rates soar and risk crashing the economy, or keep printing money and fuel the very usury and inflation that started the problem. It's a doom loop, and it suggests the old way of doing things is fundamentally broken. As trust in the old system of paper debt erodes, the world's financial architects are busy designing a replacement, and you should be very, very nervous about what they're cooking up. Enter the central bank digital currency, or CBDC. On the surface, it sounds modern and convenient: a digital version of the US dollar, issued directly by the Federal Reserve. No more physical cash, no more commercial banks as middlemen. Just a direct digital link between you and the central bank. It's being sold as an upgrade, a more efficient and inclusive financial system for the 21st century. But let's be clear about what this really means. A CBDC isn't like Bitcoin. BTC, created by Satoshi Nakamoto, is perceived to be decentralized. As many say that Bitcoin is time-stamping utopian universal flow meter, CBDC is the exact opposite. It is centralized control on steroids. With a CBDC, the government would have a direct view into every single transaction you make. Every coffee you buy, every book you purchase, every donation you make, it would all be logged in a central ledger. The very concept of financial privacy would be obliterated overnight. Your entire economic life would become an open book for the government to read, analyze, and, most importantly, control. It's the Palantir surveillance state's ultimate fantasy. The potential for control goes far beyond simple surveillance. With programmable money, The government could impose rules directly onto your funds. Imagine your money having an expiration date to force you to spend it and stimulate the economy. Imagine the government being able to block you from buying things it disapproves of, like too much gasoline, junk food, or perhaps books on topics it deems undesirable. During a protest, they could simply switch off the digital wallets of anyone in the vicinity. This isn't a conspiracy theory. These are features that have been openly discussed by proponents of CBDCs. It turns money from a tool of freedom into a tool of social engineering, coercion, and control. This is the terrifying endgame we could be heading towards. Human error is where artificial intelligence meets authentic intelligence. We are moving from one system of control, a debt system that enslaved nations through usury, to another, far more personal form of U.S. bondage. We could be trading the invisible chains of national debt for the very visible and inescapable bars of a digital cage. At least with the old system, you had the anonymity of cash. You had a small sphere of economic privacy. The transition away from U.S. treasuries and to digital control is a symptom of a broken system, but the proposed cure of a CBDC could be infinitely worse than the disease. It represents a potential leap from financial insecurity into an AI future of a zero labor value efficiency or digital slavery, as trillions of worthless dollars return to a rigged inflationary fragile bail-in banking system that has the right to convert your deposit into worthless shares. Or you find that left your Bitcoin on unregulated Indian employee scammed Coinbase exchange. And that is a truly terrifying thought. The world's central banks has rated gold as the world's tier 1 asset. So why be a billionaire and you can be a gold humanaire?